We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Glad you're with us today. I'm Mark Elliott. We talk retirement. It's right there in the name of the company that Brian is head of, DeckerRetirementPlanning.com. They're here to help walk you through all those different areas you need to have an idea on. That would be income. Where's your paycheck going to come from when you're retired? What about investments? Too much risk, not enough risk, the right amount of risk. Taxes, a big thing going on right now. Obviously, the big, beautiful bill passed. So now taxes, we know where they're going to be for the next 4 to 5 years. So that's a positive. Then, of course, you think about healthcare. One of the big unknown obstacles really out there. You don't know if you're going to have issues or not, but that's a big part. And then certainly estate planning is a big deal as well, legacy planning. And Brian and the team will walk you through all of that, not to mention Social Security and Medicare, the decisions we have to make. If you'd like to talk with them, you have questions or concerns, it's 833-707-3030, 833-707-3030. And then one of the cool things on the website, DeckerRetirementPlanning.com, there are a bunch of things, about 12 different things you can download, including Brian's book on retirement, The Decker Approach. That is DeckerRetirementPlanning.com under the heading of Safer Retirement Education. Download any or all. It's just there for your information. All right, Brian, Arrin, welcome to the show. Brian, you guys got a lot to get to today. Where are you starting?
We're going to start with the compounding risks in 3 different areas. Mark, we're going to talk about taxes first, then we're going to talk about inflation, then we're going to talk about stock market losses and the big difference in market losses during your accumulation years and your distribution years. These are big, very important points. So, Arrin, let's start with taxes. There's a compounding risk of delaying the payment of taxes that is trotted out by the federal government as being a positive, called the IRA. Let's throw back the curtain on this one and show why the IRA is the most tax inefficient vehicle on the planet.
Yeah, so it's kind of the common rhetoric in the financial industry that you want to kick the tax can down the road, right? It's always defer. As long as you can lower your taxes now, it's going to be better for you later. I can't tell you how many times I have people come into my office and they have this expectation that their taxes in retirement are going to be lower than they are now. Now, I don't know why that's such a common thing that's talked about or written about in the financial literacy, but I find almost the exact opposite to be true, that not only do most people need more income in retirement, but that also means that their taxes are going to be a little bit higher in retirement. And so this whole concept or affinity for deferring has to come to a head eventually, right? The only 2 true things are guaranteed things in life are death and taxes. And so the tax bill has to be paid eventually. And so the goal with Roth conversions, with managing that tax bill proactively, is to pay the tax on that money when it's going to be the lowest amount, not just when you have to pay it later when your required minimum distributions begin. So we like to show people an example that compares an individual with $1 million pre-tax balance in a traditional IRA or 401k, 60-year-old individual. And if that person were to do nothing as far as proactive Roth conversions and just pull the money out later, or if they were to take a proactive approach and actually convert that money a little bit at a time over a number of years, what the tax impact or the ramifications would be for that person. So our example assumes a 6% rate of growth on $1 million IRA balance. And at this point, that person, that 60-year-old individual, would start required minimum distributions at age 73. So about a 13-year time horizon. That $1 million has a little more than doubled. It's at that point in time at age 73, it's $2,057,000. Now, at that point, required minimum distributions begin. So this is the IRS saying you have had a long enough time period to defer the taxes on this money. They start making you take distributions out of it, pay taxes on those withdrawals, and that amount gets bigger as you get older. So that first year is about $76,000. When they turn 74, it goes to 80,000, 85, 90, and so on, so that those dollar distributions get bigger every year thereafter. So there is a better way to do this. You don't just have to sit everything in that account, wait for your time to come for required minimum distributions and start taking those polls. Here's a better way to do that. So if instead you proactively pay the taxes, meaning you pull the money out of the IRA, you put it into a Roth, you pay the taxes on that amount year over year. Our example, we start pretty heavy up front at about $225,000 a year for a 3-year period, then $50,000 a year thereafter, so that by the point in time this individual hits age 73, that required minimum distribution age, all of that pre-tax IRA balance has now been converted to Roth. So here's the numbers on that. If you go the traditional route where you don't do any IRA to Roth conversions, taxes paid during your lifetime, assuming a death age of 90, would be about $656,000. You'd pass that money to your beneficiaries, typically children, and they would pay about $807,000 in taxes. Total tax bill, just over $1.4 million. The net value your heirs would receive is just under 1.4, $1,374,000. Now, in contrast, let's look at the numbers for proactively paying the taxes year over year, doing those IRA to Roth conversions. Your tax bill as the owner would be about $305,000. Pass that money to your beneficiaries, they'd have a small bill of about $28K, total tax bill of about $330,000 versus $1.46 million on the traditional route. So you've saved yourself over $1.1 million in taxes during your lifetime. Then we look at the value that your heirs would receive. In the Roth conversion strategy, it's $4.2 million. In the traditional IRA route, it's $1.4. So not quite $3 million, but pretty close. So this is likely to be one of, if not the largest tax saving strategies available to you. And it's going to be beneficial both for you as the account owner and for your beneficiaries or children that receive those funds after your passing. So there's some nuance to this. When you do those, how much you do based off your tax situation now and when you retire. But we do Roth conversions for almost all of the clients that we work with. And that is one of the best things to do to make sure that you aren't stuck with a massive tax bill that you can't control as you get later into your retirement years.
And Arrin, go through the summary numbers again. 30 years of an IRA growing at 6% a year, total taxes paid was what?
It's $1,463,000 combined with.
And the net transfer up to beneficiaries after taxes was less than that, 1.2. Think of that. The IRS got more in 30 years of an IRA growing at 6% than the beneficiaries. Instead of paying 1.4 million in taxes, how much did the person with the Roth conversions pay?
It was $333,000.
Okay. And it's really a concept of proactively paying taxes now so that the growth on the after tax is all tax free. Now, the numbers get even bigger if tax rates go up, and there's 37 trillion reasons why tax rates probably will go up. Anything else you want to say on taxes before we talk about inflation?
The only other thing I would say is that people underestimate the flexibility that you'll want with that money. Once required minimum distribution age begins at either 73 or 75, you don't have a choice whether you take those RMD amounts out or not. The IRS forces you to do so. And if you don't, they penalize you and then you still have to pull the money out. So by doing those Roth conversions, not only is it the smart thing to do from a math standpoint, a tax standpoint, but it also gives you an incredible amount of flexibility around when you spend that money or if you spend that money. Again, if legacy is a high priority, that's better for your beneficiaries as well. So that's the last point that I'd make there.
Okay, so let's talk about a very important risk in retirement, which is inflation. With our planning that we do at Decker Retirement, there's 5 ways that we minimize the inflation risk? Go through those, Arrin.
Yep. So the first one of the 5 is going to be what we call the COLA, or cost of living adjustment. So everybody knows that inflation is going to be a fact of life, right? It's just something that we've had. It's very likely that that will continue in the future. And we want to make sure that for the clients that we're working with, the income that's comfortable now is still going to be comfortable in 5 or 10 or 25 or 35 years. We want to make sure that that standard of living is still upheld. So one of the things that we build into the financial plans that we create is a cost of living adjustment. It's a planned annual increase to make sure that your income is keeping up with inflation, making sure that you have the same spending power as you did in the past. So that's item number 1. The second thing that we account for is the equity in your home. So hard assets like real estate are a form of inflation protection. So for a lot of our listeners that are here in Utah, we saw that happen when inflation jumped up over 9% a couple of years ago. The home values here in Utah outpaced that by a considerable amount. In some areas, we saw 15, 20% increases in home values when inflation was high at that point in time. And so the equity in your home is another way to be able to hedge against inflation. So if there were to be a need later down the line to be able to tap that equity, whether it's through a HELOC, you actually need to sell the home for whatever reason, you have the ability to have that as a safety net in addition to your retirement assets or other liquid assets. The third one is kind of paired with the equity in your home, a downsize in your primary residence. So a lot of times we have people that have families, they bought a bigger house, lots of bedrooms to make sure that they could house everybody. As you get older, probably don't want as much maintenance, don't want to have to deal with the yard and a big house or stairs. So we have a lot of our clients that downsize their primary residence, and this typically brings with it an infusion of cash into the plan. So maybe you sold your house for 1.5, you bought another property for 800,000. You get the other portion, the rest of that equity, to go do what you'd like with it. And that is also another form of protection against inflationary pressures over time. Number 4 is inheritance. So a lot of times clients will get funds from parents, aunts, uncles, other relatives or friends. And that is something that can help with inflationary hedging, where you have a little bit more money than you originally expected based off of inheritance received. And then last but not least is the conservative assumptions growth rate wise that we put on what's called our risk bucket or our market-based investments. So when we project out the rate of return that the plans are going to get for the risk portion of the portfolio, we put a very conservative 6% rate of growth on that investment bucket. Now, in reality, that is not the historical norm. Our risk strategies have averaged well above that. And so if you compound that over time, you have quite a bit more in those risk bucket funds to help provide for inflation protection and additional income amounts to be able to take versus the original protected amounts. And we do that not only on the risk bucket but with also the other principal guaranteed or protected forms of investments that we put into the plan. So those are the 5 things that we typically account for when we help you look at what's going to help you protect against inflation, hedge against inflation. Anything you'd add to that, Brian?
No, you covered them all. So we try to make sure that inflation exposure is real for all of us, but we try to minimize that inflation risk.
So if you'd like to talk with the team at Decker Retirement Planning, with Brian, with Arrin, with any of the team at Decker Retirement Planning about this, boy, are we doing that? Do we know where we're going to be with inflation, with taxes and Roth conversions? Should we be doing that? All you have to do is give them a call. There's no cost to you, 833-707-3030, 833-707-3030. It's just a conversation. Might be one of the more important phone calls you make. We are talking about a 15, 30-minute phone call compared to the next 20, 30 years of your life. I think that time is worth it, don't you? 833-707-3030. Ryan and Arrin back with more of Safer Retirement Radio right after this.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833-707-3030. Again, that's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker of Decker Retirement Planning. Arrin Wray joining us as well. 833-707-3030 if you have questions about anything that they're talking about today, right? Roth conversions. Should I be doing that? Makes sense for a lot of people, does not make sense for everyone. Inflation, how do we handle that? We're going to get into market losses. What happens if I lose money while I'm working in the market compared to when I lose money in the market when I'm not working? How does that play out? 833-707-3030. Again, is the number, no cost to you whatsoever, no obligation, no pressure. 833-707-3030. All right, Brian, you and Arrin you're getting into market losses now.
Right. On market losses, there's different risks that we're going to layer into this conversation. And Arrin, I'll take the first one on. There's a difference between market losses during your 20s, 30s, 40s, and 50s and when you're retired. So in your 20s, 30s, 40s, and 50s, you're in your accumulation years. You max out your 401k, you put it all in the S&P, and you let her rip. Markets are down 40, 50%, no big deal, because you've got the time it takes for the markets to come back, typically 4 or 5 years. And then you've also got the money going into the market. Every 2 weeks, you're putting new money into the market. And so when the markets recover in 4 or 5 years, you've dollar cost averaged in, you're the better for it. But now that's during your accumulation years. Your income is coming from work. Now let's flip it. You're 65, you're retired. Your income is coming from your portfolio. Now your portfolio is down 40 or 50%, and you're drawing income from a down portfolio. That is terminal. That sends many people back to work. So the accumulation strategies that get you to retirement are not the strategies that you use when you retire. Distribution strategies are what you use when you retire. When I needed a new knee, I didn't go to a dentist. Dentists are good people. I went to an orthopedic surgeon specializing in putting in new knees. And so we are specialists in retirement planning using distribution strategies. Again, to repeat, the accumulation strategies that get you to retirement will in fact hurt you in your retirement years when you need distribution strategies. So that's layer one. Now, let's talk about compounding risks of market losses in view of sequence of returns. So Arrin, person A retires January 1 of 2000. Person B retires March of 2003 at the bottom of the market. One retires at the top of the market, one retires at the bottom of the market. They each have $1 million in retirement. So you play out person A, I'll play out person B.
Yeah, so person A is going to be in a pretty poor position in a very short period of time. So if you think about the stock market returns in 2000, 2001, and 2002, it was down all 3 years, 9, almost 12, and almost 22 respectively. So had you retired January of 2000 and had a majority or all of your portfolio in an index fund like the S&P 500, over that first 3-year period, you'd have been down 40% just from market losses. if you are also taking money out of the account to live off of, which most people were, because that's the retirement funds, that's what they're using for their monthly expenses, you would have been down even more than that, probably over 50% in just a 3-year period. Now you can imagine losing 50% of your funds in a 3-year time span does not bode well for the longevity of that portfolio. It doesn't bode well for you being able to spend the regular income that you were hoping to be able to take out of those accounts. So by Brian's term, sequence of return risk, what it's referring to is when the losses happen and when the positive or the good years happen, where especially if the negative or drawdown years happen early in retirement, like for those people starting their retirement years in 2001 or 02, that leads to long-term very poor outcomes versus if the first few years have a positive or a growth amount for you there. So for those people that had to start in January 2000, a lot of those people were the ones that the articles were written about in 2002 and in 2008, right? Because we get some recovery from 2003 to 07, but those same people got hit with another 40% drop when the real estate bubble burst in 2008. And those were the people that had to go back to work, move in with their kids, sell their houses for another source of funds, make some of those not so fun financial decisions because of the timing of when those market drops happened for them. So, Brian, what would you add to that?
Nothing, you covered it. Now, person B that retires at the bottom of a market with $1 million never has to worry. His timing was perfect. So I remember, who's the guy that in Dirty Harry, after a quick gunfight, they didn't know how many bullets they shot. And then Clint Eastwood has his huge revolver in the guy's face and says, "Hey, I forgot how many bullets I shot. Do you feel lucky, punk?" So when it comes to retirement, sequence of return risk, if you retire at the wrong time and you're pulling money out of a fluctuating account, you compromise gains when markets go up and you accentuate losses when markets go down. The way that you overcome sequence of return risk is by using distribution strategies and pulling money out of laddered principal guaranteed accounts. So when the markets go down 30, 40, 50%, you don't take the hit. When you pull money out of laddered principal guaranteed accounts, you're pulling money from accounts that can't lose money. Let's talk about the 4% rule here, Arrin, while we're talking about sequence of return risk. That's the distribution strategy recommended by many banks and brokers.
Yeah. So the concept, or like the rationale that people will give behind this, is they say, okay, over the long run, stocks average in between 9 and 10%, bonds average in between 5 and 6. So I'm going to be conservative. I'm only going to pull 4% of my portfolio out as income every year. That way, I'm going to be okay because that withdrawal rate of 4% is below the average growth rate of stocks and bonds. Now, what they're really doing when taking a 4% withdrawal approach is essentially flipping a coin on whether they're going to have a good market or a bad market for especially the early years of retirement, like we talked about with the sequence of return risk. So if you are one of those people that retired January of 2000, you're taking your 4% per year out, you're down 40% over a 3-year period from market losses, then you've got to add in the 4, 8, 12% that you've taken out as income over that 3-year period, meaning you're down 52% over a 3-year span. Now you have some positive recovery in the market, but again, you're also taking 4% per year out. So like Brian said, when you're taking a flat percentage withdrawal, you are compromising gains on the upside and you're accentuating losses on the downside. So it leaves you in a very poor position, especially if the sequence of return risk comes to bite you, where there's poor market returns or poor asset class returns in the early years of your retirement years. So with the way that we approach things by splitting out the responsibilities, where we are not withdrawing money from a fluctuating account. We don't take money out of what we call the risk bucket that's going to have the volatility both up and down. We draw the income that our clients are taking from a principal protected account. So when there are down market years, those accounts will not lose money. So where we don't just take a set percentage withdrawal amount, it helps us to be able to have a more consistent income level over time. The second thing that the 4% rule is lacking on is consideration of the other facets of your financial plan. So when you get into retirement and you start taking income, it's probably not just going to be from your 401k or your IRA accounts or other retirement accounts. You're probably going to have multiple sources of income. You'll have Social Security, you might have rental income, you might have a pension, you might have other things that are going to provide you with income. And a flat percentage withdrawal does not account for those other things, nor their timing distributions. For example, maybe you retire when you're 60 years old and you can't start Social Security yet, but at 62 or 65 or 70, you start taking your Social Security out. You're probably going to need less from your retirement portfolio than the 4% that you were taking previously. Same thing if you have a delayed pension or you buy or sell rental income. There's going to be other changes in the income streams that you have that you want to account for when deciding how much and when to pull that money out of your retirement portfolio. So again, the plans that we build are not just a set percentage withdrawal. We take into consideration many factors to make sure that you are pulling the right amount at the right time so that that holistic plan has all of those puzzle pieces fit properly together.
I think in the next segment, Arrin, let's make sure that we go through how to properly do Roth conversion calculations and where in the portfolio to do Roth conversions. For example, we would never do Roth conversions in buckets 1, 2, 3, 4, or 5. Those are cash accounts. Those are 3, 5, 7, and 10-year principal guaranteed accounts. Those accounts don't have the longevity or the long runway that we're looking for, and the higher rates of return. It's only the risk accounts. But in the next segment, we'll go into the calculations that we use to properly calculate how much to do in a Roth conversion each year.
833-707-3030 is the number if you'd like to talk with the team at Decker Retirement Planning about any of this, or maybe something else has you concerned about, do we have enough? Are we going to be okay if we retire? It's certainly an opportunity for you to get some clarity into your own retirement picture. 833-707-3030. No cost to you. I don't know why you wouldn't take advantage of this. Great opportunity for you. Any questions, concerns on your mind, ask the team. They're here to help. 833-707-3030. Back with more Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, you can always go to the website to learn more, deckerretirementplanning.com. And again, on that website, under the heading of Safer Retirement Education, there's 12 different things you can download. There's a checklist challenge, a sample income plan, the 3 principles of retirement book, Brian's book on retirement, the Decker approach, 12 different things you can download, and it's all for your information. That is deckerretirementplanning.com under the heading of Safer Retirement Education. You can always call with questions or concerns, 833-707-3030. Or Brian and Arrin are going to talk about Roth conversions. You're like, well, I haven't really done that. I wonder if I should do that. You got questions about that? Give them a call, 833-707-3030. All right, Roth conversions, where you're headed this one, Brian, right?
Yeah, to do the proper calculations to find out each year how much to do in a Roth conversion. Arrin, go through the calculations of gross income minus standard deduction, AGI, look at the headroom, cover all that for us.
Yeah. So the high level question that we're answering, or the main point that we're looking at when considering Roth conversions, is when are you going to pay the least amount in taxes? So there's a couple of things to consider here. The first is going to be what your expected tax rate is in the future versus what it is today. Now, most of the time, like I mentioned earlier, high majority of the time we do Roth conversions for our clients. In rare occasions, there are time periods where we have clients that have a really high income or taxable income now. They're making $400,000, $500,000, $600,000 a year now, but the retirement income expected taxable income is going to be a little bit lower. It makes sense to be able to wait to do conversions until that point in time. But if you're in a current tax bracket that you're expected to be in the future, or if your income in retirement is expected to be a little bit higher, then Roth conversions are going to be a useful strategy for you. Now, mechanically, the way that we do this is we want to make sure that we're doing it at the best tax bracket for you over time. So typically, we will look at where your current taxable income is within the federal marginal tax bracket. So as an example, let's just say that you're in the 24% bracket. You're making, $250,000 a year. Right now, the 24% bracket for a married filing jointly couple goes up to $394,600. Now, that cap at $394,000 does not include your either itemized or your standard deductions. And so if you took just the standard deduction at $30,000, you can have almost $425,000 in income and still stay within the 24% tax bracket. So we'll basically say, okay, John and Jane, here's where your income is. Here's the room you have in between your income and the top of that taxable income bracket, including your standard or itemized deductions. Here's the dollar amount that we would recommend doing as an IRA to Roth conversion. And then we chip away at that IRA balance over the course of a number of years to slowly whittle that down, get more money into those post-tax accounts. Now, one of the other things I want to hit on here is how the taxes are paid over time. Because sometimes people say, yeah, that's great. We want to do as much in Roth conversions as possible, but where in the world are we going to get the money from to be able to pay the hefty tax bill to do that? So there's typically two main ways to pay the taxes on an IRA to Roth conversion. Option number one is you pay the tax bill out of pocket. So for example, if we did a $50,000 Roth conversion, you convert that whole thing. Come tax time next year, you have that as a 1099, gets added on to your taxable income, and you have to pay for your federal and state taxes for that $50,000 Roth conversion at that point in time. Option B, second option here, is through what's called withholding. So for example, this would be do a $50,000 withdrawal from the IRA, but we send the taxable portion for the federal taxes, taxable portion for the state taxes over to the federal and state tax institutions. The net amount would then go into the IRA. So let's just say it's $35,000, $15,000 is withheld for taxes. Put the $35,000 into the Roth IRA so you don't have a big tax bill that you have to come up with some income or some money out of pocket for if you don't already have that set aside. Now, you do have to be, or we recommend that you be over the 59 and a half age threshold to be able to do that. Because if you try to do a withholding for the tax payment below that retirement threshold of 59 and a half, you do still incur that 10% early withdrawal penalty. It does count as a withdrawal. So we only do this for clients that are already over 59 and a half. Now, it is better if you have the ability to pay for the taxes out of pocket, because that means that you're going to get more money, more dollars into the post-tax Roth IRA. But if you don't have that extra discretionary money set aside, it's still best for you to pay the withholding, get the money into the Roth, and continue to chip away at that strategy versus not doing a conversion at all. So, Brian, anything I've missed on that to this point?
No, you covered it.
So this is something, again, it's nuanced. We want to make sure that we do it appropriately for you, which is why we build out those holistic financial plans, those income distribution plans, to make sure that we aren't missing anything when calculating both what your taxes are going to be now, what they're going to be later, what to do for Roth conversion, how much to do for Roth conversion. Like Brian said, we don't want to do it on all of your money, because doing a Roth conversion and then spending the money a year or two later as income really doesn't give you the long-term compounding advantages of having done that conversion to those post-tax dollars. So some things to consider, but again, it's very likely to be the highest tax saving strategy available for you. And we want to make sure that it's done appropriately so that you can take advantage of those Roth dollars later down the road.
Okay, Arrin, now let's talk about the opportunity cost of not switching from accumulation to distribution. A few minutes ago, we talked about accumulation strategies, buying and holding, S&P while you're at work, in your 401k, your income's coming from work. Every 2 weeks, you're putting new money into the market, and then you retire. So bankers and brokers are very good at getting you to retirement. Once you're in retirement, many changes need to be made from accumulation to distribution strategies. Let's take these one at a time. One is to have a plan. Talk about, Arrin, how the pie chart is not a plan. Talk about what it doesn't tell you, like your income.
Yeah, absolutely. So this is something that I feel like is kind of me jumping on my soapbox, that so many people are told that their asset allocation is their plan. So that's what Brian was referring to when he talked about the pie chart. You log into your 401k account, your IRA account, whatever specific account you're looking at, and it'll show you a pie chart essentially of what the asset allocation breakdown is. How much is in stocks, mutual funds, bonds, cash, whatever the positions are. And a banker or broker will call that your plan. But all that tells you is what your money is invested in. It doesn't tell you how much income you can pull out of it every month or every year, how much to do IRA to Roth conversions for, any other tax strategies that could be applicable there, how long your money is going to last you. There's so many things that are important to a complete retirement plan that a pie chart or an asset allocation chart does not help you with. So if you have an advisor or somebody telling you, hey, here's your pie chart, here's the plan, you can go ahead and take 4% of this per year, please come talk to us, because you're putting yourself in danger with missing all of those other aspects. So it's one of those things where I feel like people get into specific habits over the 20, 30, 40 years that they're working, which are great. Those accumulation habits of just saving, investing, riding the market movements, compounding that money over time. But what has gotten you to where you are now, those habits that have gotten you to where you are now, successful, having those retirement assets, those are not the same things that you need moving forward. Like Brian has mentioned a couple times, there's a very big difference between the accumulation portion of your life and the distribution portion of your life. And you need an expert in the distribution focus to be able to meet all of those specific needs, make sure that you're not missing anything when it comes to that second phase of your financial life.
Okay, let's also cover, well, along with the first thing, a pie chart is not a retirement plan. The number one fear of people 65 and older in the United States is running out of money before they die. I think that's because they look at their pie chart and they have no idea how much money they should draw. They're totally guessing and they know it. So a distribution plan helps them know how much money they can spend with a COLA, cost of living adjustment, up to age 100. So we plan that out. Second thing, let's talk about. Oh, go ahead.
Sorry to jump in here. One other point there is we actually have a lot of people come in that are already retired and they have this set amount that they're spending because it's comfortable. It's kind of what their basic expenses are. They spend a little bit on some discretionary or fun things, but they to your point, they don't want to run out of money. And so they don't spend any more than they think they are absolutely needing for necessities. And so I like to call it the Goldilocks principle. We don't want you spending too much income, but we also don't want you spending too little income. We want you to be able to enjoy the hard work that you've put into building up those assets and getting to a good place to retire. And so one of the main things that our income distribution plans do is they pinpoint exactly what the optimal income spend is, where you are spending a good amount to be able to enjoy it, have those fun things, be able to have the extra discretionary money there, but also not put yourself in jeopardy of running out before the point in time that you pass away. So again, we don't want you just bare bones scraping by, saving it so that you have that large safety net. We want to optimize that so you both get to enjoy it, but also don't run out before you pass away.
Good. Okay. Let's continue then. Another accumulation strategy that will hurt you in retirement are owning bond funds when interest rates are going up. So interest rates from 1940, the 10-year treasury was around 2%. It grew over 40 years to about 15% in 1980. It was a rising interest rate environment for 40 years. Then from 1980 to 2020, 40 years of decline to the bottom at 0.47% August of 2020. In the last 5 years, anyone who owns bond funds, bankers and brokers told them that that's their safe money, but they've lost over 35% in the last 4.5 years. So bond funds in a rising interest rate environment lose money, and yet bankers or brokers tell you that that's their safe money. That's another one that we don't use, when it comes to portfolio construction. None of our clients have interest rate risk because none of our clients have recommendations to own bond funds. Talk about buying and holding indexes in a flat market environment.
Yeah. So again, kind of contrasting accumulation versus distribution. Over the long run, everybody knows that the stock market is a great wealth generating vehicle. If you look at the S&P 500, for example, it averages in between 9 and 10% on a long-term time horizon, key being long-term. If you look at it on any given year, you could be up, you could be down, and sometimes violent amounts, right? 30, 40, 50%, depending upon the time period. So when you're looking at what are called flat market cycles, these are periods of time in the history of these indexes where you go a 10, 15, 18-year stretch where there is no positive momentum in those indexes. So the most recent example of this was January 2000 to about 2013. So if you look, the stock market had a huge run up into the late 1990s, all the tech and internet companies, the year 2000, peaks. We have a 3-year drawdown, about 40% in total, get some recovery up through 07, 08. The real estate bubble burst, we're down another 40%. And it was almost 2014 before you got back above the January of 2000 highs. And so that is not a singular incident. If you look at just the last 100 years or so of the S&P 500, that's actually happened 3 times, 1929 to 1946, and then 1962 to the early 1980s. Both of those were periods of 17 to 18 years where you basically just bounced within a range. You'd make a big drop, make some headway, positive momentum, bounce back down. And so over those time periods, your portfolio didn't grow up until you got past that 15, 18-year mark. So the reason that this can be so devastating in retirement is if you retire, you have what most people have, 60, 70% of your portfolio in index funds like the S&P 500. And then you go a 10 or 15 or 18-year time period where you don't make any positive growth on that money while pulling funds out to be able to live off of for those monthly expenses. You can see that that's not going to set you up for success from a long-term or a longevity of that portfolio perspective. So where we differ here at Decker Retirement Planning is that we, number one, don't put 60, 70% of your assets at risk. We typically have about that amount in those principal guaranteed accounts, have a smaller portion, the minority of the funds, allocated to risk or volatile investments. But the second is we have a variety of different investment strategies that can be applicable for the funds that are held within those risk accounts. And for those, they are long-term time horizon funds. Again, we're not drawing directly from a fluctuating or a risk-based account for income. These are funds where you have 10, 15, 20-year time horizons on them so that when that volatility happens, not if, but when, you're prepared for that because you have the protected or the safe portion of your portfolio providing income. You don't need to draw money out of an account that's just taken a big percentage hit. So those are crucial principles, crucial things that you need to include to make sure that you don't get stuck in a position where your portfolio is taking a big hit. You now have to take a bunch of money out for income, and it might be another 5 or 10 years before it really recovers from that dip.
So do you know how your portfolio is set up? Do you have 100% at risk? Do you have 0% at risk? Do you have 50-50? Don't really know for sure, maybe. This is one of the opportunities, I think, that are super important to figure out your income strategy, your investment strategy, tax strategy. They're all kind of tied together. And so do you want all your money at risk? That means your retirement is variable, right? The market goes up. Oh, we can do stuff. Market goes down. We can't do anything. Nobody really wants that. So the opportunity is here. If you'd like to have a conversation with the team at Decker Retirement Planning, 833-707-3030, 833-707-3030. There is no cost to you. Take advantage. 833-707-3030. Back with more and our final segment of today's Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
Do you want your retirement to be affected by who is in the White House? I didn't think so, but here's the thing. No matter who wins this time, they'll only be in the Oval Office for 4 years, but how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there is another presidential election in 4 years, then another, and of course another. Brian Decker at Decker Retirement Planning can help you create a customized plan that's really as White House proof as possible. Schedule your visit with Brian Decker today by calling 833-707-3030. Brian doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Brian Decker to get started. Call 833-707-3030. Don't let who's in the White House affect your retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, you can go to the website to learn more, DeckerRetirementPlanning.com. And there is a heading of Safer Retirement Education on that website where it allows you to download like 12 different things, including Brian's book on retirement, The Decker Approach. That's on the website, DeckerRetirementPlanning.com, to learn more about Brian, Arrin, and the team, where the offices are, all that information, as well as you want to learn more about retirement. 833-707-3030. If you have questions or concerns, you want to chat with the team, you certainly can. 833-707-3030. As always, Brian, you guys have covered a lot of ground already. Where are you headed in our final segment?
The One Big Beautiful Bill.
The One Big Beautiful Bill is contains some new legislation for seniors 65 and older. Arrin, what do you know?
Yeah, so there's going to be a few things that'll be applicable. A couple of the main ones are going to be a new bonus deduction. So the way that this works is it's set to be $6,000 for seniors age 65, and that's doubled for married filing jointly couples to $12,000. And that deduction is in addition to your standard deduction of either $15,000 or $30,000. And so this is going to be an extra boon tax-wise, right? So if you are getting $30,000 as your standard deduction, you've got an extra $12,000 write-off against seniors age 65 and older. That's $42,000 on your deduction that you don't pay any taxes on. So that's going to be really, really helpful for people to be able to keep more of that money in your pocket. Now, a couple of things related to that from a Social Security standpoint. They gave a couple of examples here that the average Social Security is about $24,000. And a lot of those people could pay no tax on Social Security, depending upon where your other income is coming from. So if you have about $24,000 in Social Security, you've got the deductions there, plus the additional deduction of either $6,000 or $12,000. That's going to give you more of that Social Security money that's not going to have taxes assessed on it. So again, age 65 and older, $6,000 for an individual, $12,000 for a married filing jointly couple, just an extra deduction for our seniors there. So one other thing on this, the deduction is set to phase out based off of income limits. So just like a lot of the other stuff, Roth contributions, things of that nature, they have specific income limits. So for this one, it starts to phase out at $75,000 for a single individual. And for married filing jointly couples, it's double that again, $150,000. It starts to phase out that extra $6,000 or $12,000 deduction there.
Okay, so with the two credits that are provided in the One Big Beautiful Bill, 88% of 65 years and older seniors pay no Social Security tax. Please explain that.
Yeah, so the way that Social Security taxes work is a little different than the taxes that you have on long-term capital gains or regular income. So it's kind of a funky calculation that includes a portion of your Social Security benefit. They take half of your Social Security benefit, and then the maximum you could pay is up to 85%. So the ranges are either 50% up through 85% on a cap there. And so what they're doing or what they're talking about there is for the average Social Security amount, which is about $24,000 a year. If you have all of those deductions added together, that's going to mean that your Social Security income is under those thresholds. And so you wouldn't have to pay the federal taxes on your Social Security income because of that additional deduction that they've added for you there.
Anything else on the one big beautiful bill before we go back to a couple other pieces of accumulation versus distribution strategies?
Yeah, just a couple of side notes for people. There's a lot of stuff in this bill, right? I think it was almost 1,000 pages when they actually passed it. And so there were some things that they talked about for people specifically in the real estate industry, whether that's through rentals or other things. So bonus depreciation is back. Opportunity zones are being given a second chance. So if you're in the real estate world and you have a hand in rentals, or you're looking at opportunity zones to be able to up the basis on some of those long-term investments that you've had, those things are coming back on the table. There also are some of these that are permanent changes, like the tax brackets. There's others that are just for Trump's presidency. So you want to make sure that as you're taking a look at some of these, especially the tax implications here, you want to make sure to do those in a timely manner. Again, some of them are quote unquote permanent, like the keeping of the income brackets that we have, the federal marginal brackets that we have now. Others of them either do phase out or completely stop at the point in time that Trump's presidency ends. So be aware of the timing restrictions there as well.
Good. Okay. Great information. We wanted to make sure we had that in today's radio show. Let's continue on and just finish the show with other items that are very important that we don't do in accumulation versus distribution. Now, you mentioned that there's been 4 times that the S&P 500 is traded above a market valuation of 30 times trailing earnings, only 4 times. One was 1929, and the markets were flat for 17 years. 1964, and the markets were flat for 18 years. November of 99, and markets were flat for 14 years. In November of 2021, we hit 32 times trailing earnings. We expect that 100 years of history won't be wrong. So we're hoping for the best, but planning for the worst. We're expecting that the markets will trade up and down, but basically flat for the next 10 to 15 years. Now, people in retirement, that's devastating. So there's 3 ways that we lower client risk. One is quantitatively. Most people have 60 or 70% of their portfolio in the stock market. We think that's insane. We drop it down to about 25, 30%. Second, we eliminate interest rate risk by eliminating bond funds like we talked about a few minutes ago. But third, Arrin, spend a few minutes on how strategically we lower client risk by talking about momentum strategies and dividend strategies, allowing our clients to make money in up or down markets.
Mm-hmm. So when you're looking at the world of available investment strategies and what we would call the risk portfolio or volatile-based strategies, the goal really is to be able to make money over the long term. And obviously, any portfolio is going to have some volatility there, but there's much better ways to approach that than others. So like we talked about earlier, if you're just doing straight index investing, there's going to be years that are really, really good. There's going to be years that are really, really poor. And you're going to go through those flat market cycles where you have a 10 or 15 year period where you don't have any positive growth on that portfolio. There's better ways to be able to invest that money still with high returns, but without taking on as much drawdown and trying to minimize as much as possible those options for the flat market cycle. So what we have available here at Decker Retirement Planning is referred to as an actively managed portfolio. We also call it our two-sided models, two-sided managers. These are actively traded strategies that have really a twofold goal in mind. Number one is to provide you with a high rate of return. And number two is to minimize the volatility to the downside when markets perform poorly. Because if you can minimize or prevent some of those big drop years, the 2008, early 2000s type periods, it means you don't have to spend the next 1 to 5 years digging yourself out of that hole. So it's a great way to be able to still have exposure to the market, but not do so in a way that's going to leave you with the same drawdowns as those strict index investment strategies would. Now, the second part that Brian mentioned is the dividend strategy. So the dividend strategy is another way to be able to take advantage of market movements, but do so in a manner that's going to help you minimize drawdown over time. Combining those together is a great way to still have exposure to the market, but do so in a more protected manner.
So again, if you'd like to chat with the team at Decker Retirement Planning about any or all of this, all you have to do is give them a call. There is no cost for this. 833-707-3030. 833-707-3030. No cost, no obligation, no pressure. Just a great opportunity for you to get some clarity into your retirement picture. 833-707-3030. Brian, Arrin, appreciate the time. Enjoy the rest of the weekend.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.